The money in your bank account is not actually really there. This is not a metaphor and it is not conspiracy talk. If every customer went to the bank tomorrow and tried to withdraw the money in their account, the system would collapse instantly because the money is not actually there. This is not an accident or a malfunction. This is the design of the global financial system. It is such an old, such an entrenched trick that we have started to accept it as normal. It is called fractional reserve banking, and it is the engine behind global debt, inflation, and the illusion of wealth. Once you see how it works, you will understand that money itself is built on promises that can never truly be kept. To understand how this came into existence, we need to go back to a time when our world did not run on numbers inside an app. In medieval Europe, gold and silver were money. If you were wealthy, you had coins in your pocket or jewels you could trade. But carrying bags of gold was too dangerous, so people began leaving their valuables with goldsmiths who had secure vaults. In return, the goldsmith would give a receipt. It was a simple note promising that the bearer could return and take their gold. Soon people realized they could trade these receipts instead of real gold. After all, the note represented the value just as well and was easier to carry. This is where the trick was born. The goldsmiths noticed something. Almost no one came to collect their gold at the same time. If they had 100 customers, maybe only 1 or 2 would come for their gold in a day. That meant most of the gold just sat there. So the goldsmiths got clever. They began issuing more receipts than the gold they actually had. If they held 1,000 coins, they could issue 2,000 receipts. They realized they could lend these extra receipts at interest and make a profit from gold that did not actually exist. As long as everyone did not demand their coins at the same time, no one noticed. In essence, this was money created out of nothing. This was not just a nice side business. It was revolutionary. The moment people accepted paper receipts as being as good as gold, money creation was freed from physical reality. Banks were born from this practice and institutionalized the trick. By the 17th century, even governments adopted it. The Bank of England was founded in 1694, not to serve the public, but to solve a problem. The crown was drowning in debt from endless wars. The bank lent the government far more money than it actually held in reserves and received interest payments in return. The debt was paid not with treasure from new conquests, but with the taxes of ordinary English people. Sound familiar? Because the mechanism governments use today is the same, borrowing money that does not exist, and then paying it back by taxing future generations. The United States followed the same path. The first American banks printed banknotes redeemable in gold, but they soon realized they could print more notes than the gold they had to back them. Periodic bank runs exposed the illusion, panicked depositors demanding their money only to realize it was not really there. Entire banks collapsed overnight. And yet, instead of abolishing the system, governments doubled down on the trick. They created central banks to support the illusion. The message was clear. Even if the money does not exist, we must make sure the public keeps believing that it does. Now let's break this down in today's terms, because fractional reserve banking is so abstract it can feel like smoke. Imagine you walk into a bank and deposit $100. You might think that money is sitting safely in your account. In reality, the bank is required to keep only a small fraction of it in reserve. In the past, this might have been 10%, meaning the bank kept $10 and lent out 90. Someone borrows that 90 to buy groceries and the shopkeeper deposits it into another bank. That bank keeps 9 and lends out 81. The money is deposited again, lent again, and this continues. By the time the cycle ends, your original $100 has turned into almost $1,000 in the economy. But here is the key point. Only the first $10 actually exists as cash. The rest is debt. Every new dollar in the system is born as someone's obligation to pay it back with interest. If that surprised you, I have bad news. What I just told you is already an old story. In the United States today, reserve requirements are not 10%. They are 0. Since March 2020, the Federal Reserve has required banks to hold nothing, not a single dollar, against the deposits they take. That means the neat little multiplier no longer controls how much banks can lend. So if banks do not need reserves, what stops them from lending forever? The limit today is not reserve requirements. It is capital and liquidity rules set under a global framework known as Basel. The Basel rules were created after a series of crises, especially after 2008, by central bankers and regulators meeting at the Bank for International Settlements in Basel, Switzerland, the so-called Central Bank of Central Banks. They are not written by Congress or Parliament, but by unelected technocrats. Here is how it works. Banks must prove they have enough equity capital to absorb potential losses. The rules are complex, but imagine this. If a bank wants to make a risky $100 loan, it may be required to hold $8 of its own money, shareholder equity, as a buffer. That is the real constraint. The more risky assets a bank takes on, the more capital it must hold. In addition, banks must prove they have enough liquid assets to survive a short-term crisis, cash, government bonds, things they can sell quickly. These rules are meant to stop banks from flying too close to the sun. But notice what has changed. Banks no longer lend out deposits. They create loans first, and those loans create deposits. When you take out a mortgage, the bank does not pull cash from a vault. It types new money into your account. That new money exists because you agreed to pay it back. Then the bank checks whether it has enough capital to cover the risk. That is why in the modern system, more than 90% of the money in circulation is not central bank money, not cash or reserves, but money created out of nothing at the moment loans are issued. Think about that. When you look at the money in your checking account, it is not the same kind of money the Federal Reserve prints. It is bank money born as debt. That is why the money supply keeps expanding as long as banks can find borrowers. And that is why every financial crisis is also a crisis of confidence. Because when borrowers cannot pay or when banks cannot roll over debt, the whole system begins to collapse. This system creates three unavoidable consequences. First, inflation. Because banks keep multiplying the same dollars into more and more credit, the value of each dollar erodes over time. Prices rise not only because of supply and demand, but because the currency itself has been diluted. Second, permanent debt. Because money is created as a loan, there is always more debt in the system than there is money to repay it. Interest ensures the balance sheet never closes. Someone must always default, refinance, or borrow more. Third, concentration of power. Banks collect interest on money they never truly had. Governments use this system to finance wars, social spending, and bailouts without directly raising taxes. And the wealthy, who own real assets, real estate, stocks, commodities, benefit as inflation pushes asset prices higher, while ordinary workers watch their wages lose purchasing power. When this machine stumbles, the illusion cracks. Look at the Great Depression. In 1929, banks had lent far beyond their reserves, creating a stock market bubble. When panic hit, depositors rushed to withdraw their money. But it was not there. Thousands of banks collapsed. The same thing happened in 2008. Banks multiplied credit through mortgage-backed securities, creating a housing bubble built on the same principle, more promises than reality. When defaults spread, the system nearly collapsed. And once again, governments and central banks pumped in trillions to keep the system alive. They laid out the trick itself, because without it the modern economy cannot function. And this is where the global picture matters. In the US, reserves are completely gone. In Europe, the United Kingdom, Canada, and Australia, reserve requirements are already symbolic or non-existent. They all rely on Basel rules now. Meanwhile, in emerging economies like China, India, and Brazil, reserve requirements still exist, often in double digits, and are actively used to control credit growth. But even there, Basel capital rules sit on top, shaping how much risk banks can officially take. No matter where you live, what limits money creation is not deposits in a vault. It is regulations written in Basel, Switzerland. The uncomfortable truth is this: the system cannot tolerate you being debt-free. If every household paid off its loans tomorrow, the money supply would collapse. Banks would have nothing to lend. Economies would grind to a halt. The illusion depends on your participation, on your borrowing, spending, and believing that the numbers in your account represent something real. You are both the fuel and the collateral. That is why history matters. The same mechanism used by medieval goldsmiths has become the foundation of modern finance. And the same dangers still exist. The bank runs of the 19th century, the Great Depression of the 20th, the global financial crisis of the 21st, all are echoes of the same story. A trick that multiplies promises beyond reality and a public that believes until belief becomes impossible. And make no mistake, this story is not finished. Every major financial crisis we have lived through is a reminder that the system's stability rests not on gold or productivity, but on confidence. And confidence is the easiest thing to lose. So the next time you look at your bank balance, remember this: most of it exists only on paper, born from a debt system that was never designed with your freedom in mind. When you understand the trick, you can begin to protect yourself from it. When you ignore it, you remain just another player in a game where the house always wins. If this gave you a new perspective, subscribe. History holds the answers, and I will show you where to look.